Today I want to talk about how to build $1 million in your retirement plan. That's not a sales pitch, that's reality. I want to talk about how to build a richer retirement. Whether you're just starting out in a job or you've been there a while or you've really been there a while, whether you've got the greatest job on the planet and can't ever imagine leaving, the reality is we all leave. At some point, we hang it up, we move out. And whether that means we're on a beach somewhere just kicking back, or we just want to have the freedom to do what we want, when we want, do it on our time frame rather than on an employer's time frame, we need to plan for that. What I want to do today is go through a couple of key lessons, key points. Ultimately, the best thing to do is to develop a full and detailed retirement plan incorporating all the specifics of your situation. But there are a couple of key points I can run through to kind of help you in that process. I've jotted down some notes and want to make sure I cover the best ones. The first one, you need to play for the long term. What do I mean by that? What I mean is compound interest is one of your best friends. It's something that Einstein actually said was the closest thing to a miracle that he's ever seen. You might ask yourself, what is compounding? Let me use just a quick example. Compounding is when interest earns on top of interest. So let's say you invest $1 and you're earning 6%. In the first year, you earn 6%. But in the second year, you don't just earn 6% on the buck. You earn 6% on the buck plus 6% on the 6% you earned the previous year. The next year, now you earn 6% on the buck and 6% on the first year 6 and the second year 6, and this goes on. So you earn 6 and then 12 and then it actually becomes like 19, and this grows, and it grows in a compounded fashion. It allows you to really generate money quickly. In fact, jotted down some notes here. If you started in your 30s, all you have to put aside is $14,900 per year, and you'll have $1 million by the time you're 65. If you're starting in your 40s, it's $23,600. If you're in your 50s, it's $31,400 per year you put aside. Now, that might sound like a lot of money, but each of those is actually pretty reasonable for that age bracket. If you're in the 30s, 14 grand's not that big a deal. 40s, 23, 50s, 31. These are relatively easy numbers if you plan for them, and trust me, they will generate $1 million by the time you're 65. Second key point, you need to stay for a while. And what I mean by that is, wherever you're working, you need to be there for a reasonable period of time. Most employers' plans will have two components, or maybe one of two components. First is a waiting period, a time that you have to be an employee before you can get into the retirement plan or the 401k. And the second is something called a vesting period. You have to stay long enough in order to be able to take the money with you that the employer is kicking in. Let me talk a little bit about each one of those. The typical waiting period is 1 year. So if you're job hopping and going from job to job to job, you're putting into your retirement plan essentially a series of 1 year stops. That's going to hurt you. You want to try to avoid those. Now let's talk about the vesting period. Most retirement plans out there have some form of an employer contribution. The most common one is usually something along the lines of 50% of either 5 or let's say 6% of the contribution that you would make. So what that means is if you put in 2% of your pay, the employer puts in 1. If you put in 4, the employer puts in 2. You put in 6, the employer puts in 3. As you can see, that's pretty generous. It's a 50% return on your money in the first year, guaranteed no matter what the stock or bond markets do. You put in 6, he puts in 3. Right off the bat, you've got something. But most employers aren't doing that just out of the generosity or the goodness of their heart. They're doing it because they want to retain good people. And the operative word here is they want to retain you. So they usually have a vesting schedule. Now, any money you put into a retirement plan is always yours. You can walk the next day. You get to take your money with you. But the money that the employer puts in, you got to stay a while. And it's usually something along the lines of 6-year vesting, where if you're there less than 2 years, you get 0. After 2 years, you get 20%. After 3 years, you get 40%. It goes 20, 40, 60. By the time you've been at that employer 6 years, you now own 100% of the money that the employer has put in. You can leave the next day, you take 100% of yours. You always get to take 100% of yours, but now you get to take 100% of the employer's money as well. So as you can see, staying for a while makes a lot of sense to avoid both the waiting period and to get through that vesting period. Third point, you don't want to retouch your retirement money. The good thing about these retirement plans, 401ks, is the tax advantages they give, and oftentimes the employers match. The bad thing is a lot of these plans give you the opportunity to borrow money. You borrow it from yourself. You're supposed to pay money back to yourself. In theory, it's great. In practice, not so great. There was a study that showed people who borrow from their 401k will save less 40% of the time afterwards. 15% of the people that have borrowed from their own retirement plan stop contributing altogether. So if we go back to point number one, playing for the long term and starting out and investing per year a certain dollar amount, you can see if you fall prey to these statistics, what the average person does, you're going to stop putting in as much money, or you may stop putting in money altogether. Leave the retirement money as retirement. Do everything you can to avoid tapping into it, even borrowing in it. Next point, number 4, don't let stocks scare you. Remember I referred to compounding, I think I used the example of 6%. Well, let me give you some different parameters. If you were to invest your money 100%, let's say, into bonds, you'd probably earn about 4%. If you invested your money 100% in stocks, you're probably going to earn about 10. These are long-term averages, but they're very realistic. Well, think about this from a common sense perspective. If you're compounding 4%, 4, 8, 12, etc., versus you're compounding 10%, 10, 20, 30, which do you think is going to give you more money quicker and help you to get to that $1 million mark faster? Clearly, it's the 10%, leaning towards the stocks. Now, why do I say don't be scared of stocks? Because stocks are very volatile. They're going to have years where they're up 30%, maybe even up 50%. They're going to be years, unfortunately, where they're down 10, 15, 20%. If this is truly retirement money, don't be afraid of investing in stocks. Put up with the volatility. Take that average 10-year rate of return I mentioned and let it compound rather than the smaller number. Point 5, be careful about employer stock. There are some company plans out there that either allow you to invest in the company that you're working for, or they mandate that a certain portion of your 401k or your retirement be in company stock. Usually the way that works is that the match they give you is employer stock. The employer stock could be great. You could be working for Apple. It's a great company, it's well managed, it's great stock. You're probably in a better position, or you're in the best position actually, to know whether it's a well managed company or not. But again, common sense here makes the difference. If I were to come to you with a complete clean slate, not be talking about your retirement plan, but just be talking about an investment option I've got for you, and I said I want you to invest 100% of your net worth, or even 100% of your retirement money in one company, you'd know that I'm foolish. You'd say, no, I want to diversify. And the same thing needs to take place inside your retirement plan. So the question is, what's your number? If it's not 100%, it doesn't need to be 0%. You don't need to be afraid of employer stock, but you do need to think about a reasonable percentage. If you are a very, very aggressive investor, 10% of your net worth or your investment assets invested in any one company would be considered the threshold. If you're less than an aggressive investor, let's just say a moderate investor, that should be about 5%. That's a number for you to decide, but the point is you need to decide what that is, and it ought not be too high a number. Lastly, sixth lesson here, when you leave, leave. What I mean by that is, a lot of these retirement plans will let you leave, but you can keep your money in the employer's retirement plan. That's good for the employer because the price that he pays is usually based on the number of people that are participating, but it's not necessarily good for you. 401ks have lots of great options, lots of tax advantages. They usually come with a match, but they also come with a restricted set of investment options and higher expenses. So when you leave, the best thing to do is roll your money over into your own IRA, individual retirement account. You still get to keep it from the tax man, but you'll get lower costs typically, and you'll get a wider array of investment options. Better to manage your money. So, 6 quick lessons on how to build a richer retirement, and trust me, it's not just a pitch. It's a very, very realistic number to think that you can have $1 million by age 65.